We've just had strong subscriber numbers for Disney, for its Disney Plus service, but given the stock price is still slightly down year to date, is this a buying opportunity or is all of the good news already in the price? I thought it'd be interesting to do an update on Disney. Considering we've just had earnings from the company, you can see since March of last year, it's been a strong performance, going from $80 a share, trading briefly above 200 in March of this year. It's off slightly for the year so far, but broadly speaking, that trend from those March lows is still up. So I thought let's take a look at it in a bit more detail, take a look at the recent news, these subscriber numbers, then come back onto the charts and see what the technicals say, because I wonder, is this a buying opportunity down here, or are we seeing all the good news already in the price? I'll talk a bit more about Disney, then we'll come back and look at it in more detail. Hello, I'm David Jones from Capital.com, and I thought this time round on our stocks channel, we'd look at a well-known stock that's just had earnings. So we'll have a look at Disney in a bit more detail and explore the Disney Plus side of their business, because I think that is something that has seen really strong growth. So as usual in this video, I'll talk a bit about the recent news. We'll look at the levels to watch, then we'll jump back onto the platform and take a look at the chart in a bit more detail and see what the technicals say. If you're watching this and you haven't subscribed, if you could click on subscribe, it does help support the channel, and it means we can continue to look at different videos, different stocks throughout the week. Right, let's get into it and take a look at Disney in a bit more detail. So just in case you're not familiar with the Walt Disney Company, it was founded back in 1923, so we're not far away from its centenary celebrations. First came to the market in 1957, so it was from then that you could buy stock in Disney. We've had the company's recent earnings. These beat expectations. I think there was strong earnings. Expectations were for around about 55 cents per share, earnings per share, and this came in at 80, so comfortably ahead of what the market was forecasting. There's a lot of focus on its streaming business to rival the likes of Netflix, of course. Again, total subscribers was ahead of expectations. So subscriber numbers at the moment are sitting at 116 million, which is double where it was a year ago. So that really has been incredibly strong growth. But the company expects more to come. It expects something like 230 million subscribers by 2024. To put this into perspective, Netflix at the moment has got 206 million, something like that, subscribers. So ahead of Disney and Disney Plus. But clearly Netflix has had a long time to build up that subscriber base. So the growth for Disney subscribers is very impressive. Like many stocks, it's had a good 18 months or so since those March lows in 2020. We've seen the price of Disney stock more than double. This year has been a bit more disappointing. So far, year to date, despite some volatility over its earnings, Disney stock is slightly down, but only by a few percent on the year so far. So given the grand expectations for subscriber growth over the next few years, is the market undervaluing it? Is it a buying opportunity, or actually has the stock gone far enough? We'll take a look at the technicals on the chart in a second. First of all, let's look at the big levels to watch. So for me, the most immediate hurdle on the upside is the high so far this month, coming in around $190 a stock. After that, we've got the all-time highs set earlier this year, and they're in at $204. On the downside, lots of support on the way up. $167 is the most recent major low over past months. But as usual, to put some color on these numbers, let's jump on the charts and take a look at things in a bit more detail. I thought, as usual, let's start things off with our 20-day moving average. And this has actually ended up being, it's almost a textbook example of how moving averages do not work very well when markets are sideways. They're great when markets are trending. We had the crossover through the moving average in November last year as the price moved through around 125. And the next leg of the trend higher, we had the cross below the moving average in March of this year as the price fell through 190, crossing below the 20-day moving average. But just look at the last few months, because the price has been pretty much sideways with the odd burst of volatility. the price and the moving average end up being quite close together. And what this means is if we're looking for crossovers, clearly if they've got roughly the same value, we're going to get a lot of crossovers, and most of them aren't going to be very good. So lots of false signals when the price and the moving average is flip-flopping so close to each other. So I don't think we're getting too much from that at the moment. If we take a look at the RSI, we had that blip higher on the earnings, and it pushed the RSI into overbought. It was the most overbought it had been for about a month. We go back to here, the 12th of July, and again you can see it did do a reasonable job of calling a short-term top in Disney, but we're still stuck in this overall sideways range. If we saw a bit more weakness from here, perhaps down towards 170 again, the RSI may go oversold, giving us a shorter-term buy signal. But I thought let's take a look at the bigger picture here for Disney, the trend. Let's take a look at the price action. Hopefully it's clear from here. We'd have to say that, broadly speaking, the trend off those March lows is still up. We've got that trend line coming in around about 165 a share. So while we're above here, we still have higher highs, higher lows, and that trend is still up. It has gone sideways over the last 3 months, but no market moves in a straight line. And sometimes as investors, well, a lot of time as investors, I think we need to learn to be patient. I think we could argue that the correction from the highs is over. Those March the 9th highs, just shy of $204. We've seen the market stop making lower lows, but we haven't really seen that much of a turnaround. So for me, big levels to watch from a support point of view. These lows in May, around about $167 for the stock. They have and continue to provide good support. 167 to 170 has been good support for the stock. It has tried to break higher through 190 more recently, but not quite just yet. We have that better support back here, or I should say stronger support again, around about 158 from the end of January. So broadly speaking, while we're above this 158, 170 area, from a technical point of view, I think the bias still is for an uptrend. So when it comes to targets, if we're looking for this trend to resume, the first hurdle, I think, is that 190 high from the earnings. Perhaps if we can find some momentum through there, then the target becomes the old highs, just ahead of 204. And I think, again, if we break there, perhaps we have a bit more momentum again and start to look at $220 a share. So somewhat sideways over the last few months. The broader trend is still up. Lots of good support just below where we are now. But we need to find some momentum to see if we can target those old all-time highs once again. That's it for this update in Disney. We'll see how they fare over the months ahead. We'll come back to them. It's a popular stock, and see if they can perhaps set fresh all-time highs. But for now, from me, David Jones and Capital.com, we'll leave things there. Good luck with your investing. For more trading videos just like this, please subscribe to our channel.